Hey everyone, welcome back. Today we're going to look at banking basics. So, a couple remarks. The first thing is that it is just the basics. We're doing a quick overview. If you happen to know a lot about banking, then you might not learn a lot from this lesson because it really is just the basics. The second thing is that we're going to talk about personal banking. So, your own personal use, when you go to the bank, get a checking account, you spend money, that kind of stuff. It's personal, it's just you. And if you're looking for financial advice, I tell you to speak with a financial services representative at a bank. And if you happen to like what we're talking about in banking, you can get more info in other courses like in business, economics, or accounting. Okay, so the first thing is income. You get money, but work at a job, you got some money as a gift, and you deposit this into what's called a checking account. And this checking account is an everyday use account. You use it, any money that you plan on spending, you keep it in your checking account. There's a monthly fee, and there's different types of checking accounts. Some have, say, 10 transactions, some have unlimited transactions, but for a different fee, stuff like that. And so when you become older, you can see which checking account is best for you. Tip for you is a student account. There's no fee for some transactions. Like when you go and withdraw money, that counts as a transaction. And for a student account, typically cash withdrawals are free. There's no fee for you if you set up a student account. And so with this checking account, you can write checks, for example, to your landlord later if you're renting an apartment or something. So once it's inside your checking account, you can do basically three things. You either keep it there, spend it, or save it. So I'm going to talk about saving for a bit right now. So when we're saving, there's short-term saving and long-term saving. So short-term saving, there's an account called savings account, and there's different types of saving accounts. And the idea is that you put money aside for, let's say, a purchase, like a new computer. And the money that is in the savings account will earn a little interest, right? The bank will pay you a little bit of interest, so that's good. And the thing about this type of savings account, the short-term one, is that you can have access to your money really easily. You can transfer from your savings to your checking account very quickly. You'll have access to this money anytime. The downside is that the interest is lower compared to a long-term saving, right? You don't get paid as much if you had it in this savings account compared to a long-term. So long-term savings. So there's many options. I'm just going to talk about the most common. The first one is a tax-free savings account, Tfsa. And so let's say you had $5,000. You could put it in your savings account or tax-free savings account. And the interest that is earned is considered as income. And so you get taxed on that income. That interest that you make by putting your money in the savings account is taxed. So if you had 5,000 in here or 5,000 in here, you will gain more interest with the Tfsa. So another type of option is GIC, Guaranteed Investment Certificate. And so this is money that you don't touch until the certificate is matured, and then you get paid the interest that was agreed upon. Another thing is RRSP, so this is for retirement savings plan. Another type is RESP, so Registered Education Savings Plan. So if you're saving up for your kids going to college or something like that. Another one is mutual fund. So this is stocks, bonds, and other securities. And so one of the good things about the long-term saving is that the interest is higher. You're really putting it away to not touch it, and you will gain a higher interest rate. The bad news is that you have less access to the money. Sometimes you even charged a fee if you do decide to take out some of the money from these longer-term saving options. Right, so we got spending, saving, short-term saving, long-term saving. And so let's talk a bit about spending. Okay, so spending. First thing is cash, right? You go to the store, bring some cash, you pay it, end of story. Debit card. So this is the card that you use to access to your bank account when you go to the bank. And when you go to a store, you can actually use that same card to make purchases. And the money comes straight out of your checking account. E-transfer. So this is sending money electronically. It's most common for when you're sending money to friends or family. You get their email, you send it through e-transfer, and then they receive the payment. Check. So with a check, you write the amount and the name of the recipient where only the recipient can deposit the check. So this is more secure than giving cash, right? You put that person's name on, let's say Bob, you give him the check, and if somebody steals the check from Bob, they can't do anything with it. It has to go in an account with Bob's name on it. So that's why a check is more secure than giving cash. So credit card. So this is spending, but it's also a bit of a loan. And so credit card. When you pay by credit card, you are borrowing money. There's a minimum amount due at the end of the month. And if you do not pay back all of the money borrowed, you will be charged interest. And the interest rate can be pretty high. It could be around 20%. And so as you continue to use your credit card, your credit rating rises if you continue to pay on time. What's a good credit rating? So a good credit rating shows that you are worthy to borrow money and can be trusted. And so your credit rating will be looked at by banks, landlords, telephone companies, and more. And so here's a good little tip. What you want to do is get a credit card as soon as you can, and you use it to make most of your purchases. But only spend the money that you have so that you can fully repay what you owe at the end of the month. And so this practice allows you to build your credit rating without paying any interest. And another side note is that a lot of banks will have a credit card for students that have no monthly fee. So that's also worth looking into. Okay, let's talk about loans. So these are just some examples. First is credit card. We just talked about that. The next is called the personal line of credit, or PLC for short. And so this is an amount of money that's readily available for your personal use. So you have quick access to it. Just like that short-term savings account, you have quick access to it. Just do a quick transfer from your PLC to your checking account whenever you need money. And so the interest rate is actually quite low on PLCs, usually 4 to 6%. And the amount available will depend on your income and credit rating. So here's a tip. It's better to have a loan on a PLC than your credit card, because the interest is lower. So if ever you can't fully pay off your credit card, use money from the PLC to pay off the credit card. Okay, mortgage. So a mortgage allows you to buy a home without having all the money up front to pay for it. So you can think of it as a loan for a home, and the interest rate is usually quite low. And so a loan to own a home, it could be a house, a condo, a chalet, whatever, we call that a mortgage. Auto loan. So this type of loan may come directly from the car dealership. And a little tip is to be sure to compare with a loan from the bank to see which has the lower interest rate. All right, so sometimes a bank can say, oh, we can beat that interest rate, come rent with us, or loan with us instead of the car dealership. So it's worth looking into. And student loan. This is a loan for your studies that usually only needs to be paid back after you've completed your studies. And so that's it. That's it for now. So we covered the basics of banking, and so I'll see you guys in the next video.